Here's something almost nobody tells you. You can be right about a trade more than half the time and still blow up your account. And you can be wrong more than half the time and still come out ahead every single year. The difference isn't your strategy. It's not your indicators. It's not some secret stock pick. It's one number. And by the end of this video,
Ever
you'll
wonder
know
why most
exactly
traders
how
fail?
to calculate
It starts
for
with
every
bad
single
entries.
trade
Even
or
worse,
investment
they have
you
no
make
exit plan.
in
But the biggest killer is
2026.
poor position
If
sizing.
you've been trading or investing for a while, you've probably already
This
had
is
a
it.
winning strategy
This
on
formula
paper
changes
that
everything.
still lost you money in real life. That's not bad luck. It's almost always one root cause: position sizing. Risking too much on a single idea means one or two bad trades can wipe out 10
This
good
setup
ones.
minimizes your risk.
Risking
It ensures
too little means even a great strategy barely moves the needle. Most people never sit down and actually do the math. We're going to do that math right now, and it's simpler than you think. Here's the core formula professional risk managers actually use. Position size equals account risk in dollars divided by risk per share or unit. Let's break that down with real numbers. Say you have a $10,000 account and you decide, like most professional traders, that you'll never risk more than 1% of your account on a single position. That's $100. Now, say you want to buy a stock at $50 and your stop loss, the price where you admit you're wrong and exit, is at $48. That's $2 of risk per share. $100 divided by $2 equals 50 shares. That's your position size, not a gut feeling, not it felt right. Math. Notice what this formula does automatically. It doesn't ask, how much do I want to make? It asks, how much am I willing to lose? That single shift in thinking is what separates people who are still trading in 5 years from people who aren't. Here's the part that surprises most people. Your win rate is almost irrelevant on its own. What matters is expectancy, how much you make on average per trade over time. The formula: expectancy equals win percent times average win minus loss percent times average loss. Let's say you win only 40% of the time. You lose more often than you win. But your average win is $300, and your average loss, because you stuck to your stop loss, is only $100. 0.4 times $300 equals $120. 0.6 times $100 equals $60. $120 minus $60 equals positive $60 per trade. You're wrong 6 times out of 10 and you're still profitable. That's the entire game. It's not about being right. It's about making your wins bigger than your losses on average and sizing your position so no single loss takes you out of the game. If you're more of a long-term investor than an active trader, the exact same math still applies. It just looks a little different. Instead of a stop loss, your risk per unit is how much of your total portfolio sits in one position. A common professional guideline is to cap any single stock at somewhere around 5 to 10% of your total portfolio, depending on your risk tolerance and conviction level. Why? Because no matter how much research you've done, you can be wrong. Companies you're sure about can still drop 30, 50, even 80%. If that position is 5% of your portfolio, a disaster costs you 2.5 to 4% of your net worth. If it's 40% of your portfolio, that same disaster could take a decade to recover from. Diversification isn't about giving up on conviction. It's position sizing applied to investing instead of trading. 3 things destroy this system faster than anything else. 1. Moving your stop loss further away mid-trade. This isn't giving it room to breathe. It's quietly turning a 1% risk into a 4% risk without admitting it to yourself. 2. Revenge trading. Doubling your position size after a loss to win it back is the single fastest way to turn a bad week into a wiped out account. 3. Sizing up after a winning streak. Confidence after a few wins is exactly when people abandon the formula, right before the market reminds them why the formula existed. 3 things destroy this system faster than anything else. 1. Moving your stop-loss further away mid-trade. This isn't giving it room to breathe. It's quietly turning a 1% risk into a 4% risk without admitting it to yourself. 2. Revenge trading. Doubling your position size after a loss to win it back is the single fastest way to turn a bad week into a wiped out account. 3. Sizing up after a winning streak. Confidence after a few wins is exactly when people abandon the formula, right before the market reminds them why the formula existed.
Not personalized financial or trading advice. All investing and trading carries risk, including the risk of loss, and past performance never guarantees future results. Always do your own research and consider talking to a licensed professional before making financial decisions. If this helped, subscribe for more frameworks like this one. And let me know in the comments, what's your current max risk per trade?